Hi, I'm Mr. Simons, and in this video we're looking at external stability policies to achieve external stability. In the series of videos before this, we've been looking at the issue of external stability, the economic issue, and particularly we've been looking at how external stability is really made up of three components. So external stability relates to the current account deficit, external stability relates to net foreign liabilities, and it relates to the Australian dollar. In this video, we're looking especially at the policies to address external stability. When we think about the policies, there's a couple of points we need to know. One, that external stability is not a major economic goal of the Australian government. It's not like price stability or reducing unemployment. This is partly to do with the Pitchford thesis, or the consenting adults argument, where the issues of CAD and foreign debt, they mainly involve the work of the private sector, risk takers who know what they're doing, and that their activities don't necessarily involve the government incurring debt. It's about the private sector incurring debt. So the government leaves them alone to do their thing. But that doesn't mean the government does nothing. If the government side of the debt, or the national debt, is getting too large, then the government will act. But we need to think about what policies will it use. So in thinking about the policies to achieve external stability, there are four policies we can think about. So let's start with monetary policy. Monetary policy being the use of the cash rates by the RBA. So monetary policy could be an option because higher interest rates could result in fewer imports, which could then improve BOGs and the current account deficit. So that would hopefully be positive. So this would be a positive for external stability. But there's an issue here. If we have higher interest rates, this is going to have two impacts. Number one, this is going to slow the economy, and that's bad news for an economy. But number two is higher interest rates are actually going to increase capital inflows. And if we increase capital inflows, well, okay, that's going to actually increase the current account deficit because there will be larger NPY outflows. So if we look at interest rates, this is not really how we address external stability. If we look at fiscal policy, this is more on the right track because with fiscal policy, the government can address the savings investment gap. It can run a budget surplus, which increases the level of national savings available for investment. Make that narrow. And then this will reduce the amount of foreign debt that's required. So this could be quite a good strategy to reduce Australia's reliance on external funding. Because if we have less foreign debt, okay, then we're going to look at less repayments and then the less need to borrow more money and maybe extract ourselves out of that debt cycle. One way to increase national savings is through specific policies like compulsory superannuation. Now, superannuation being those payments that are put away from a worker's salary and are there until retirement. So this can be and this could be a positive for the government having that extra amount of national savings. There is another policy involved, which is microeconomic reform, very much looking at supply side reforms, looking at the work of industries and producers. The idea with microeconomic reform is that the government could encourage greater international competitiveness so that firms are able to sell more exports at lower prices. And this in turn could also help with Australia's financial relationships with other nations. So if we're looking at the policies to achieve external stability, know that monetary policy is an option but is not typically used. Fiscal policy, building up national savings to reduce the reliance on foreign debt, indeed foreign equity, is also an option. And then compulsory superannuation as part of fiscal policy, and then microeconomic reform, making Australia's export industries more internationally competitive.